Welcome to everyone. This week's video will cover the S&P 500 index for the week of October 6, 2025. Before we start, make sure you read carefully the disclaimer. Despite the 38% rally since the major low on April 6, 2025, the S&P 500 index hasn't reached its 6,859 20-week target or the 7,321 40-week target yet. I believe it's time to evaluate different possible scenarios for yearly cycles. For this reason, this week I will explore very long-term cycles. Let's start with the Hurst nominal model. J.M. Hurst created this model after discovering that stock markets repeat similar patterns regularly. This model works for cycles ranging from minutes to multiple years. Very important point, cycle lengths are averages. Hurst has a rule of variation. Sometimes an 18-year cycle can last 20 years, another might last 16 years. What matters most is staying close to the Hurst nominal model average. Also, in bull market cycles usually run slightly shorter, and in bear markets they tend to extend longer. We'll start our very long-term analysis by going back to the main 20th century low in 1932. Using closing prices chart for the S&P 500 index until 2020. Where I switch to bar charts. From the 1932 low point, we'll use the 18-year cycle. Adding 18 years to the 1932 low gives us 1950 as a potential target for the next 18-year cycle. Let's see what happened by 1950. During this first 18-year period, we had two 9-year cycles, the first forming a low in 1942 at 7.66, and the second in 1948 at 14. 1948 was the first 18-year cycle. The second 18-year cycle formed a low around 1966. The first 9-year cycle hit 40.84 in 1958, and the second reached 76.56 in 1966. This cycle was exactly 18 years long. The third 18-year cycle was expected in 1984. The first 9-year cycle should occur in 1974. And the second in 1983. In 1974, the S&P 500 index formed a major low at 63.54. The second 9-year cycle had a major low in 1982 at 107.09. 1982 marked the beginning of the 1980s Great Bull Market. According to Hurst's rule of synchronicity, this third 18-year cycle is also the 54-year cycle, see the nominal model. This 54-year cycle lasted 50 years, only 4 years shorter than the nominal model, just 8% shorter over 50 years, showing very good performance. We can confidently label 1982 as the 54-year cycle low. This coincides with the sideways market from the 1960s. The correction from the previous bull market lasted 14 years. This first 54-year cycle ran from 1932 to 1982. Adding 54 years to the 1982 low gives us 2036. If this 54-year cycle follows Hurst's nominal model, around 2036, plus or minus a few years, we can expect the S&P 500 to form a major low around 2036, after a possible sharp decline. Let's look at the next 18-year cycle. 1982 plus 18 years equals 2000. 2000 was the dot-com bubble. The bubble peaked in March 2000 before a dramatic 34% crash, forming its low in October 2002. From August 1982 to October 2002 is 20 years. To simplify calculations, I rounded to 20 years, though this 18-year cycle actually lasted exactly 17 years and 2 months. Inside this 18-year cycle, the first 9-year cycle should form around 1991 and the second in 2000. The first lasted 8 years, forming a low at 304 in 1990, and the second in October 2002, lasting 12 years. Projecting the next 18-year cycle from the October 2002 low gives us 2020. The year of the big correction blamed on COVID. In fact, we were already expecting an 18-year cycle low to form. COVID may have simply amplified the decline. This shows the power of cycles. No matter what happens, cycles never disappear. Depending on the cycle length we expect, corrections will be more or less significant. Some analysts place this 18-year cycle in 2018, but I think that's unlikely. However, for analysis purposes, let's keep this as a second scenario. Projecting the next 18-year cycle from the 2020 low gives us 2038 as the next time target, 2 years later than the 54-year projection of 2036. Now let's explore shorter-term cycles from the 2020 low. The next short-term cycle in Hurst's nominal model is 54 months, or 4.5 years. Adding 54 months to the 2020 low gives us between 2024 and 2025. In April 2025, the S&P 500 made an important low right on the 18-month cycle trendline VTL, the yellow trendline. From the March 2020 low to the April 2025 low is exactly 61 months. 7 months longer than the 53.77 Hurst nominal model. To identify the actual 54-month cycle low, we need to examine the next lower cycle, the 18-month cycle. One 54-month cycle contains 3 18-month cycles. Let's begin with the first scenario, with the 18-month cycle starting in March 2020. The S&P 500 had a very bullish first 18-month cycle, ending in September 2021, exactly 18 months long. The second 18-month cycle lasted 13 months, ending in October 2022. The third was even shorter, 11 months to October 2023. Since the market was forming a long-term cycle bottom, this explains the huge rally following this correction. With high degree of confidence, we can label October 2023 as the 54-month cycle low, not April 2025. This 54-month cycle lasted 42 months, and the 18-month cycles within it averaged 14 months, which is common in bull markets with shorter lengths. Adding 54 months to the October 2023 low gives a time target of 2027 to 2028. The first 18-month cycle following the October 2023 low formed a low in April 2025, the green semicircle, finding support on its VTL, the yellow trendline, and lasting exactly 18 months. We can expect the next one to form in October 2026, and the third in April 2028. The October 2026 and 2028 lows are calculated using the 18-month average from Hurst's nominal model. Of course, these dates will be updated according to the actual lengths of the two 18-month cycles. This will also complete the second 54-month cycle since the 2023 low. By Hurst's synchronicity rule, this will also mark the end of the 9-year cycle. Around that date, we may expect an important correction. To keep this video as short as possible, for more analysis on shorter terms like weekly cycles and the second scenario, I recommend visiting my website, tradingmarketcycles.com. In conclusion, market cycles follow predictable patterns based on Hurst's model. The S&P 500 is currently in its second 18-month cycle that should complete around October 2026. The next major 54-year cycle low is projected for 2036, suggesting continued long-term growth with periodic corrections. For more details, visit tradingmarketcycles.com. If you found this helpful, please like and share this video, subscribe to stay updated with my weekly trading insights. Thanks for watching, see you next week.